During that year of buying these homes in Vegas, my Silicon Valley colleagues were absolutely mercilessly coming down and ribbing me and making fun of me. What are you doing? Nobody buys far from home. Nobody buys out of state. Are you crazy? It's never going to work. You're an idiot. But after a year, when they saw me with my 20 plus homes, the logic of the engineers started to click. And many of them started saying, you know what, we see what you're doing. We want to do it too. And I said, you really should. Go do it. It'll change your future.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Adiel Gorel. Adiel is one of the leading experts on real estate and real estate investment in the United States and around the world. He is the author of 5 books, including his Amazon bestseller, Remote Control Retirement Riches. And in just a minute, we're going to speak with Adiel Gorel about the miracle real estate investment sitting in plain sight. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guests. Adiel Gorel, welcome to CREPN Radio.
Thank you, Darren. It's a pleasure to be here.
Well, I'm delighted to have you, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
My background is actually not in real estate at all. I'm a high-tech guy from Silicon Valley. So I'm an electrical engineer and a computer scientist. I lived right there in the heart of Silicon Valley, in Palo Alto, while doing my graduate studies at the university in electrical engineering and computer science, and later teaching at the university. And then I got my first job in Silicon Valley. That was in the 1980s. Yes, I started when I was 1 year old, of course. So in the 1980s, we didn't have Google or Meta or Amazon or many of those companies. So I really was hoping I could get a job with Hewlett-Packard Labs in Palo Alto, which was where I wanted to do research. And fortunately, I did get that job. So I was actually still doing research between the university and HP Labs, living right in between. And 2 things happened when I started my job at HP Labs. I was a young guy, and they paid me a whole lot better than Stanford paid me, which is just like today when you have a young person getting a job at Google. They say, oh, wow, that's a very good salary, right? So that's how I felt. In my research group at HP Labs were people who were in their 50s and even 60s. And I thought very naturally, as a young person, wow, these guys must be very wealthy. If they've been working here for 30 years, 35 years, getting paid like this, they must be wealthy. Once I got to know them socially, I discovered that was not true. They very typically owned their own home and a 401k. That was it. So I said, look, I'm not going to work here for decades only to look like this financially. Clearly, I need to build my own empire so that when I'm 50 or 60, I will look a whole lot stronger than that. I grew up in a family of real estate developers. As a boy, I was interested in just playing. I didn't care about what my family did, but I couldn't help being exposed to the power of real estate. So I said, okay, look, here I am in Palo Alto. I'm getting paid very well. My credit is great. I'm young. I'm single. I'm going to start buying rental properties and build an empire so that I can get wealthy as time goes by. Now, back in the 1980s, there was an unwritten rule that you only buy rental homes within a 30-minute drive of where you live. That's what everyone was doing. So I was doing it too. I was a good boy. I bought in Silicon Valley. After a few homes, I realized I couldn't build an empire in Silicon Valley because the numbers didn't work. Like today, the rents were way too low relative to the prices. Of course, the numbers were much lower back then, but the ratios were just as bad. So I realized I have to break the so-called rule of buying close to where I live and find a place where the numbers are going to work, if there was a place like that. So I did a little research. Obviously, I didn't have the web back then, and Sergey Brin and Larry Page were in kindergarten. So I luckily had access to the ARPANET, that's the precursor to the internet, at my Stanford lab, and not very convenient, but still you can search. And with a little search, I discovered that if I flew about an hour and a half from San Francisco, I would land in a smaller city by the name Las Vegas. They still call it by that name, I think. And I discovered, to my surprise, that I could buy a home in Vegas that cost about 1/4 of the price of the Silicon Valley homes I was buying. But very surprisingly, the rents were much closer to 1/2 of the Silicon Valley rent. That was infinitely better. So I started flying to Vegas every weekend. Now, I always looked younger than my age back then. I looked like a boy. The people in Vegas were very skeptical. They thought I was going to waste their time. They had never seen a person buy far from home. So I decided to spend my time doing what I knew I needed to do, finding local property managers to take care of the properties I would buy. Because obviously, if I live in California and I'm buying in Nevada, I would need a local management company to manage my properties for me. After a couple of months, I found a management company that I liked. I was still very nervous because I never got a chance to really try them in the field yet. And finally, a local broker took pity on me and said, okay, I'm going to find you properties. And I started buying. Now, I was always pretty aggressive. And in my first year, I bought 22 homes in Vegas. Now, before your listeners get all impressed by that number, and also if everyone promises not to laugh, I'll tell you that the average home I bought in Vegas during that time cost $39,000 for the whole house. Those were the days, right? Not only that, but Fannie Mae back then didn't have a limit on the number of loans a person could have like they do now. And even as an investor, I could buy homes with only 10% down with PMI or private mortgage insurance, which I did because even though I was very well paid, I was young and my cash was limited, and I wanted to stretch my cash by putting the minimum down. And there's another reason that I'll get to in a second. So from that standpoint, buying 22 homes like this for a person who gets a good salary in Silicon Valley is doable. But I have to say, I had never met a person that owned 22 homes at that time. So I felt pretty good. it has, an auxiliary effect on your confidence too in life. Oh my God, I own 20 homes. Anyway, during that year of buying these homes in Vegas, my Silicon Valley colleagues were absolutely mercilessly coming down and ribbing me and making fun of me. What are you doing? Nobody buys far from home. Nobody buys out of state. Are you crazy? It's never going to work. You're an idiot. But after a year, when they saw me with my 20 plus homes, the logic of the engineers started to click. And many of them started saying, you know what, we see what you're doing. We want to do it too. And I said, you really should. Go, do it. It'll change your future. And they said, come on, you work in Silicon Valley. You know how busy we are. We don't have time. You're already there with your managers, with your homes. How about you lead us? Never thought of that before, but I said, sure, I will. So I led a group of about 20 engineers. And over about 3.5 years, we bought roughly 250 homes, not as a group. She bought 6 homes for herself. He bought 4 homes for himself. I bought a few more. But during those 3.5 years, I made the very trivial discovery that even the very cautious engineer who bought just one little home in Vegas as a test enjoyed the clout, the power, if you will, of 250 homes. Because the service providers, most notably the managers, knew if he wasn't happy, he would complain to me. And now, I'm not happy. And every other management company in Vegas was calling me all the time. Come to us. We are better. We are cheaper. We are nicer. We are taller. We are prettier. Who doesn't want to manage 250 homes, plus the many more we may still buy in the future? So I started really liking this. I felt like I was changing my own future and the future of my colleagues. And because what I was doing was so unusual back then, I started getting invited to give lectures about it to, investment clubs and in Silicon Valley. So in one of my lectures, unbeknownst to me, was a reporter for the San Francisco paper. In the Sunday paper, there was an article about this. And that led to an interview on the morning news of the local NBC station. I realized I'm liking all of this much more than my tech life, frankly. And eventually I wrapped up my tech life despite my degrees and all the investment that I made in tech. And I formed this as a company, and in the past 40 years, we've been doing the same thing. My investors bought more than 10,000 homes in about 30 markets. And out of the 10,000, maybe 2,000 were bought by people who live overseas. But the principle remains the same, except after a few years, I realized it's better to buy brand new to start with. And I have a series of magazine articles that I'd be happy to share with your listeners. One of them says, why brand new home? So I'm not going to explain it right now. So that's what we've been doing. I still remain the biggest investor, even though I have people from Silicon Valley who sold the company and bought 100 homes. I mean, so the question is, asked, why am I not retired? If I've been doing it for 40 years, I'm the biggest investor out of all these people. Why am I still here? And the reason for that will come while I explain the topic that you mentioned, the best real estate investment in this country that is hidden in plain sight. So about 40 years ago, my mind was blown to pieces when I learned that in this country, and to the best of my knowledge, only in this country, they give you something that, in my opinion, is the biggest financial gift in the world. Now, the name of the gift is very well known. The problem is how many people think about it as what it really need to be thought of. The gift is called the 30-year fixed rate loan. So people are listening to me now and saying, what the heck? Everybody knows. What's the new? Now there's nothing new here. Come on. So maybe the best way to illustrate it is what happens when I get invited to speak in Europe. So I tell the Europeans, my American investors can get a loan called 30 years fixed. They say, what does it mean? So, well, like the name implies, the monthly payment, principal and interest, is fixed all the time. It never keeps up with the cost of living, inflation, whatever it is. In addition, the loan balance, how much you owe, even though it goes down a little bit with every payment, also doesn't keep up. The Europeans react harshly. I hear things like, obviously you don't know what you're talking about. That's not possible. I can't believe I drove 100 kilometers, to hear you speak. This is nonsense. And we're going to prove to you why this is nonsense with logic. So they go, you have inflation in the US, right? Right. It's always there, right? Yes. Sometimes higher, sometimes lower, but it's always there. Yes. 40 years ago, you bought a postage stamp for 4 cents. Now it's 72 cents. 40 years ago, you went to the movies in New York City for $2. Now, $16. If you go to a Whole Foods today and you buy a beautiful organic avocado, $3. You know, we know, everybody knows. In 10 years, extremely likely it will be $6. And you want to tell us that in this environment, where the cost of absolutely everything in the US economy keeps rising with inflation, because the dollar becomes weaker because of inflation, somebody is going to be moronic, stupid, crazy enough to give you a loan that's going to be the only thing in the US economy never to keep up with inflation while everything else does. If that were true, which it can't be because it's too good, inflation would become your best friend. It would erode the real value of your loan in real dollars all the time, month after month, year after year. And you're not going to have to wait for 30 years. Probably in 10, 12, or 14 years, your loan's going to look so tiny as to be negligible, and your equity is going to be huge, and you're going to be well. This is way too good to be true. Therefore, it's not possible. Therefore, you're stupid. We made our case. Well, very compelling, very compelling. So then I say, do you mind doing a little search? So they search, oh my God, they really have this craziness in the United States. The next question is always the same. If the Americans can get this unbelievable wealth building gift, why don't they all run out every day to get as many of those gifts as possible? My answer is also the same. I don't know, but I sure did. So this is why I'm not retired, because absolutely 99% of every American I ever speak with, until I explain it like I just did, doesn't get it. The only person in the US that I was in touch with that got it from the get-go is the great Warren Buffett. He was in touch with me in 2012, was interested in buying a large number of homes for Berkshire Hathaway because he thought in 2012 the prices were still good following the big fall. And he got it. In fact, there's an article in Entrepreneur magazine about my interaction with Buffett about that. And I'll be happy to share it with your listeners. And from time to time, there is an article where Warren Buffett praises the 30-year fixed rate loan, but it's absolutely miraculous. And I want to give you an example, one out of thousands of examples that I have of what it looks like. So I get a call from one of my investors. He says, remember me? I'm the Silicon Valley guy who started investing with you guys in my early 40s. I said, yeah, I remember you. He said, I started out by buying just one home because I was very busy at my job and I didn't want to fix any toilets. I wanted to see that the property managers really do the job. I was too busy. So I bought one home and it leased out okay and it became stable and even boring. So that's when I bought another one and another one and another one. He ended up buying 19 homes. Again, not as impressive as it sounds. At the time he was buying them in his early 40s, he was buying brand new homes for 150,000 each, putting a minimum down payment because he got that he wants to get those loans. And for a guy who makes a Silicon Valley salary, not very hard. And then he goes, last year I turned 55. I looked at my 19 homes and all of them still had a loan with 17 years left on it, not even halfway through the 30-year term. But I couldn't help but notice when I bought them, I put the minimal down payment. So my loan was very big relative to the value of the home. But in 13 years, I noticed my loans were just 1/4 of the value of the homes. That's what inflation does to a loan that never changes while everything else rises all the time, all around it, including the cost of rent and houses and shoes and glasses and the tomatoes and everything. So he said, I was incredibly happy because over 19 homes, I had millions of dollars in equity. That was already amazing. But I took it one step further. I took 4 of my 19 homes and I sold them. I didn't do anything fancy, no 1031 exchanges, nothing. Just sold them and paid my tax. Used the proceeds to pay off the remaining small 15 loans. And with 15 free and clear homes, I retired from my Silicon Valley job at 55. Thank you, thank you. And he adds the one sentence that everybody always says in the future, including me, I should have bought more. So that's why I'm not retired, because I have a message, including speaking about it now, that is absolutely life-changing, hidden in plain sight, easy to do, buying brand new homes in good areas, come on, and life-changing to the nth degree. I've seen thousands of people retire, send their kids to the highest colleges in the country without even feeling it, become wealthy. It doesn't matter. Each one of these homes is a building block. How many building blocks you want is up to you.
Yeah, no, you have summed up kind of the aha realization I had. I not as profound on the. I didn't quite understand the. I guess the lock in on the cost and the appreciation and that delta that would grow and continue to grow right away. I mean, I definitely get it now. But I remember my simple thinking was, and I, as an insurance agent, I had a couple of clients. One guy was, I think he just stayed up watching TV too late because he was always, buying these horrible properties in these just like, a tree growing out of the fireplace and, just, I was going, you're going to buy that? And at the time, this is back in the 80s when Polaroid cameras were the standard as opposed to digital. And so you could shoot the camera or the picture enough to where whoever was looking at couldn't really tell all of the deficits, right? So the underwriters weren't unhappy. But anyway, he kept calling me back, and again and again and again, like you, week after week after week. He kept buying all these houses. I'm going, why? You got to explain this to me. I don't understand how you're doing this. He goes, oh. And after a while, I told him I got to get into this, and I bought one. We were sitting in the driveway of one that was just a complete. It was not a new home. It was a well-used home. But anyway, he offered it to me. I went back and did some study on the numbers and stuff. Couldn't make it work. Finally came up with a number that worked for me, and offered that to him, and was able to make the deal. What triggered my excitement about it was at the time I was a young, new insurance agent, not making very much. But I understood like the 401k, kind of like, but basically that was basically a forced savings plan. It wasn't magical and like it was exponentially growing. It was basically I was putting money in and there'd be money there when I was ready to get out. And what occurred to me was that if I did that with a rental home and the tenant paid down the mortgage, that would be like another 401k. And so in my mindset, I was multiplying my 401ks just as a way to get, additional. And then it wasn't until I went and did my taxes that I understood the benefit of the depreciation and the interest write-off and all these other things. Like, holy crap, I mean, the benefits are amazing. But what I love about you, I mean, being an engineer and understanding that, that the inflationary, the lock on your debt compared to the inflation, because inflation is really well, I guess it's not the only thing. The appreciation is essentially inflation, right?
It's both. It's both. The appreciation, that word could be
Right.
misleading because when you have an avocado that costs $3 and then a decade later it's six, the economists are not going to say there was an appreciation in the avocado sector. No, inflation made it go high. But in real estate, part is real appreciation. People move into the area, the industry has grown, and part is just
That's a supply demand thing in
yeah.
that area that makes sense.
Partly it's just inflation, just
Yeah.
inflation. I
Yeah.
remember living here in the San Francisco Bay Area. I remember very well when I saw homes here that cost 200,000 decades ago. I thought, oh my God, that is so expensive. 200, today they're 2 million.
Right.
Like that.
Right. Well, and again, in my limited mindset, and I think it was useful for me from just a simple concept. I just saw that they were going to pay off the debt with no appreciation. It was just going to go from owing money to it was free and clear. And that by itself, it was a revenue stream then as opposed to an expense. And 30 years seemed like a long time. 30 years ago it seemed like a long time, but now it doesn't seem like
No, but
so
it's
long.
not really 30
Yeah.
years because if you started out with it, you
No,
put
I'm saying, but if you just pay it, if you make all 30-year
no,
payments,
but
that was gonna, yeah,
even if you just let your tenant pay down, and by the way, it's not only the tenant is paying it down, which you're absolutely right. That's a huge thing that your tenant is paying down the loan. That's major. But even so, let's say your loan started here, and after 14 years it's down here. Yes, there's a little bit left, but it's negligible. You can even
right,
sell this home and pay off 7 of these mortgages. You know what I mean? So,
right.
so once it gets to the lower levels, it's tiny.
Right. Well, and I think the also the advantage. Well, I don't want to say the advantage, but it clearly is an advantage, and I don't think everybody understands it or appreciates it. As you mentioned, you started off in a high price market, Silicon Valley, not exactly the place people go to buy rental homes, right? But that market being what that market is, with supply and demand, the appreciation there is exponentially greater than if you went to some smaller area, more affordable to buy. But I'm assuming the appreciation in Silicon Valley dwarfs that of, I don't know. You tell me, how's it compared to Las Vegas?
Actually, surprisingly, it's not that much more. During the 40 years of doing this, our very biggest market was the Phoenix metropolitan area. And I remember starting out in Phoenix in the late 1980s, buying good homes for about 75,000. These homes today are a little more than 500,000. So when you look at Silicon Valley and the homes that were close to 200 and now they're 2 million, yes, it's a little bit of a higher, steeper curve, but not by that much.
Right. No, I mean it's not by that much, but just again, just the delta there, because you're starting with a bigger number, you're going to have a bigger gap, a bigger spread. But it did cost you substantially more to get into that home than it did.
Oh, the
Yeah.
beauty of
Yeah.
this thing is you could buy 2 homes in Phoenix, 3,
Right.
7,
Right.
7,
So by
64.
doing the math there, you can actually be even better. And then if you did want to sell one, you only have to sell one as opposed to sell one of your larger ones with more tax consequence. I mean, it's more manageable. Your exit is more manageable there.
And now you get into the secondary thing that in Silicon Valley, which is part of the state of California, the law hates the landlord. Whereas in Phoenix, the law and the landlord are fine, it doesn't hate landlord.
Yeah. No, so tell me, is the single family home, is that the focus, the single focus of what you do, or do you do any other asset classes or?
Okay, so in my 40 years of doing it, this is year 41, I have bought a large, apartment complexes, commercial complexes, subdivided land, bought land, but I always go back to the single family home. Why? Because as I said, the biggest gift that exists in this country in the real estate universe is the 30-year fixed rate loan. That loan is only given on 1 to 4 residential units. So fourplexes, unless they're in a good area, have their own issues. Duplexes, same thing. Triplexes. The single family home is the American dream. You can buy it nice in the suburbs, everything. So mostly single family homes because of that reason, where you get the unbelievable gift. So there's a notion that you start out in first grade, you buy single family home. Then you graduate to second grade, you buy fourplexes. Then you graduate to third grade, you buy 12 units. Then fourth grade, 100 units. Well, I remained in first grade because of the 30-year fixed rate loan.
Well, and the beauty of having multiple single family homes is that, while in the beginning, the spread between the cost and the income is not huge if you're leveraging them as much as you can, but because you have multiple, if you do have a vacancy, it's not an all or nothing thing. You still have revenue from elsewhere that can cover the expense. So I think that's one of the mistakes I think people, I don't want to say mistakes, but I think that if you only do one and you don't have a good experience or you have a vacancy, it can really sour your mindset or your understanding of how the game works. Any idea on like a minimum number that, I mean, I don't say a minimum, but a number where people can more comfortably, withstand some of the challenges, because there are, maintenance, or I mean, if you're buying newer homes, less so, but still vacancies are vacancies. And if
Yeah.
there's no money coming in, you've got expenses.
Yes, of course, of course. I would say that doing this and enjoying the inflation eroding your fixed rate loan is so powerful that even if somebody just bought one, and I hear what you're saying, when you own only one home, you have a vacancy, it could be devastating to you, especially mentally and psychologically, but it's better to still buy one than buy zero. Obviously, if you own 5, well, one of them is vacant, you have, if you own 10, so, the higher the number, the more negligible it is if you have a vacancy. And people start looking at it just like they look in apartment complexes as a factor. Is it 3%? Is it 5%? Like that. But still, it's so important for people to do it because I have been doing it for decades. And because of that, I meet people 15 years later. And sometimes I meet 2 friends who come to me and they've done nothing. One of them starts and they buy 10 homes, 12 homes, 14 homes. They retired, they are wealthy. The other one never did anything. There was always a reason. Oh, there's a recession coming, there's an inflation coming, there's a war in there. I sit with both of them 15 years later. This guy's crying with real tears. So doing it is important, but you're right. Obviously, because, even today, in 2025, we're buying brand new homes in good areas, starting in the very low 200s. That's very affordable. I mean, you don't need to be a Silicon Valley person to get started, or a doctor or a lawyer, even though we have a lot of those. You could be a teacher, you could be a nurse, you could be a truck driver. in which case maybe the change in your life is even bigger. And one thing that you pointed out so well was you discovered the tax benefits. So we know about all the tax benefits. And there's one more that usually people don't talk about. Sometimes I talk to people and they say, oh my God, I wish I talked to you before, because now I'm 51 and I'm clearly too old to start. I should have. Really? I get absolutely ecstatic when people call me and they're younger than 60, but I have people in their 80s beginning to buy. Why would that happen? Because of the one more miracle called the step up basis. So I have a lady who started buying with us at 84. She's 88 now, still buying. It's not only for her. One day when she passes, all these properties go to her heirs on a step up basis, which for 99.9% of the population means zero tax. Right. So, I mean, that's another miracle in the US. And by the way, talk about the 30-year fixed rate loan. The media has told people that the rates are very high now. Well, for somebody who's been doing it for decades, and for you too, being an experienced guy, the rates are actually pretty low. But compared to 4 years ago during the COVID trough,
compared to free money, yeah, it's
they're high. But you know, people forget one thing. You get a house today with a rate of 6.75, and by the way, that's not even true. The builders are desperate to sell. They will buy down your rate to 5 or 4.5 even. I see it all the time. But let's say you get it at 6.75. Well, let's assume a couple of years down the road, the rates go down to 4.5. Let's just say, I don't know. You can refinance. So not only is that the craziness of a loan that never changes, if the rates go down, you can bring it down. It is literally, when I speak it, my brain says no, too good to be true. But it's all fact.
Yeah. I think the other lesson I learned in buying, I bought, you know, when the rates were high, rates were low, prices tend to, you know, inverse. Because when interest rates are low, what the market understands is that payment buyers can afford a payment, and that payment will buy a lot more of a higher cost with a lower interest rate. Whereas when interest rates are higher, you're still the payment buyer, and within, you know, percentage or so, you're not going to like double because the price is up. You know, I got to pay twice. Your income, you know, most people's income didn't double, that didn't follow the the interest rate delta there, right? So the cost actually historically has come down or reflected. I guess I should say it more like this: the cost has typically risen dramatically when in a low interest rate period, because the margins, I mean, the math works. You know, you still have a payment buyer, and I think what most loans qualify, payments like 30% of your income. So if that number doesn't change, it's just that how much that interest rate can affect the purchase price. And I've seen that, and it's like, and then you talk about thinking you've won the lottery. You go from having a high interest rate loan to a low interest rate loan, and then the spread improves that much more. Those are fun days when you can.
But what you're saying is so true and so fundamental, and I agree with it so much. So the media, some of the media is young people now, especially with all the social media and the TikTok, young people. So the universe that they see is rates used to be 3 or even 2.5, and now they're 6.5 or 7, meaning the world has collapsed and ended. So they tell people don't move, and they manage to scare millions of people. So this is what it really looks like when you're in the trenches. So here we are, 2021, 2022, the rates for a homeowner could be as low as 2.5, investors 3.25. That's the lowest I've ever seen for an investor. So the media plays an active part in all of this. So the media starts bombarding people, buy, the rates are low. Millions of people jump in and want to buy. Now we buy brand new homes. Who sells brand new homes? Developers, builders. So the builders still were suffering from the COVID supply chain issue. Supply was low. Demand became enormous. So yeah, the prices shot up exactly as you say. And the builders said, I can be selective. I get much more demand that I can handle. So number one, I'm not working with investors, only homeowners. So as investors, we couldn't even buy anything. We had to wait on waiting lists for many months. Then the rates went up.
Yep.
The media mobilized to scare everybody not to do anything, and now millions of people are sitting on the sidelines. Guess what? In the meantime, the builders have built up the inventory. They have good supply. Demand is lower. Oh, the builders are so friendly now. They love investors.
Dear Mr. Investor, yeah.
They will buy your loan. I have one builder who will buy the loan to 3.75, buy down the rate. Yes?
30-year fix?
Actually, to be exact, that particular builder will go down to 3.75 fixed for 10 years or 4.6 fixed for 30 years.
Wow.
And by the way, which is very, very ironic, because the rates are high, you get such low rates.
Right.
But again, the media, what it doesn't get is, if you buy today, when the supply is high, demand is low, the sellers are so friendly. They will give you gifts, free appliances, free fence, free this, free that, lower price. And then if the rates go down in the future, refinance down. That's the thing. Is instead of waiting now and doing nothing, when the rates go down, guess what's going to happen? Millions of people are going to jump in. Prices are going to go up. Again, it is so clear what needs to be done.
Yeah. No, I love the aha, and and what I love what you're talking about is just how simple it is. It's really easy to overcomplicate this, and if for a minimal amount of risk, if you buying a new home, I mean, you have a warranty. There's no capital improvements. You've got, a roof that's brand new. You've got appliances that are brand new. You're probably in a new path of progress neighborhood. Schools are new. I mean, everything there is desirable. And so those homes are likely to appreciate more quickly than something in maybe an older neighborhood that perhaps doesn't have the same, key points there. Schools may be, you may be in a school district where their teachers are on strike, or they're not funding the schools, or where the city's decided that they're going to put the money in the new neighborhood, not the old neighborhood. So that's all good. That's good.
Well, in my TEDx talk, which by the way I'll be happy to share with your listener, it's only 11 and a half minutes. I say the formula is this: you buy a brand new home in the suburbs of a large metropolitan area in the Sunbelt states. I can talk about that if we want. That's affordable. You put a small down payment, you get a 30-year fixed rate loan, you let the local manager lease out the home for you, and then you proceed to do the hardest action for a human being to do. Nothing. You just let time and inflation build your wealth. That's it. That's all you need to do. So it's the good thing about this kind of way of doing things is you could be a busy teacher, you could be a busy insurance agent, you could be a busy engineer, and you can buy homes. Because property managers are doing the heavy lifting. I mean, I can tell you, I own a very large number of homes. If I were taking care of my own homes without property managers, I wouldn't be on this podcast right now. I'd be fixing a toilet at this very moment. Yeah.
No, the property management, I've become a huge fan. I've managed my own, and there's always the this, that, or the other thing that something I think I might know how to do, but 3 trips later to the Home Depot or whatever, and maybe a day of getting it done. I mean, it's a wasted day. I'd much rather have a good handyman on speed dial that I know I can call or text, and he goes out, takes care of it, sends me the bill, and then pay him promptly, because I want him to answer my call next time he calls. So, but property management, it's big. Yeah.
I feel the same, except I want another layer. I want the property management firm to call the handyman and handle everything.
Yeah.
The
No,
analogy, the analogy is I can clean my own home. I don't guarantee I'll do a great job, but I can. I can clean my home. But I don't. I hire better people than me to clean my home in a better way. So I have time to be here with you.
yeah, yeah. No, and I've become a big fan of property management. I have I think there's only two properties that I have a direct relationship with the tenant, and it's more of been it's something that I've had, and it didn't seem to. But whenever I had a turn anymore, I'm going put them in property management, and also they're able to command a higher rent. You know, they know the market and know how to market a property, and they have a pool of renters, and then they do all the screening properly, and they check on the property regularly and push the rents up. So big fan of property management, good property management, underline that. So hey, Adiel, if we could, I'd like to shift gears here for a second. As I mentioned before, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be the interest rates, could be the political environment, could be anything that inflation, anything that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Adiel Gorel, what is the biggest risk?
With your permission, I'm going to riff the answer. Not going to be one sentence, just a few sentences. So, to me, knowing what I know now, funnily enough, the biggest risk is doing nothing at all. Because later in the future, you say, oh my God, I could have owned 3 houses. Okay, so doing nothing is a very big risk, but okay, fine. Within the realm of actually doing stuff and buying rentals or buying property, to me, a big risk is buying junk. And buying junk, it's easy to say don't buy junk, but junk is very attractive. Why? Because people have a notion about cash flow. And typically, the worse the home, the worse the neighborhood, the worse the city, on paper, the cash flow looks better. Life doesn't happen on paper. So the biggest risk is to buy junk. It's like in software, garbage in, garbage out. I know people say, well, we're going to fix it. No, really? Was the fix up good? Okay. So to me, not buying new is a big risk. Mitigating it, buy new in good areas. But related to your sphere, I also consider it a risk to be underinsured. You need to be well insured on your property and get the maximum liability insurance that your insurance agent can offer. Of course, we make it so that it all is taken care of for you. But I recommend never being, underinsured, because that's an opening for risk.
No, definitely well said, especially the buying in the good market. That whole notion of the low cost, kind of thing. You might be the last guy to own that if you buy too low. You might not have one that anybody else wants to buy from you. So if you are ever needing to sell, I definitely, in a better market's a better move. So I get that. Hey, Adiel, where can the listeners go if they'd like to learn more or connect with you?
So for nearly the entire 40 years, my company has held a big event once every quarter. There used to be live events near the San Francisco airport, and people would actually fly from Seattle and Portland and Los Angeles and San Diego. But starting with COVID, we have those events by Zoom. We shortened them to 4 hours. Our last event was just on May the 17th. And our next event is on September 6th. Everyone's invited. You can register on our website, icgre.com, under events. You can register for the next one. Also, I decided not to retire, but I had to find balance in my life. So I make music in my home studio. You see some of my tools over there. In fact, I'm leaving to Los Angeles on Friday to be on a live stage with a live band 2 nights in a row, playing some of my songs. It should be a lot of fun. And then I have a health and wellness podcast, actually. But more than 50% of my time I dedicate to meeting with people because I feel this is life-changing. So if somebody wants to talk to me one-on-one, go to our website, icgre.com. There's a place to set up an appointment with me, or send us an email, info@icgre.com. If you want to get the articles, the TED Talk, the PBS show that I was invited to do, I'll send it all. And this is how you get in touch with us.
Awesome. Well, Adiel, Gorel, I cannot say thanks enough for taking the time to talk today. I have truly enjoyed it, learned a lot, and I look forward to doing it again soon.
Same here, Darren. Thank you so much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.